Hi everyone. Module 2 gives you a fairly intense introduction into accounting theory. So what I would like to do is to offer you a quick tour of the 3 learning outcomes. So this first video I'll deal with learning outcome 1, and the second video will combine the next 2 learning outcomes. Now there's a lot of slides presented for you on Moodle. You'll actually find them very useful for working through your textbook and doing revision. But for now, I just want to give you a very quick overview of the key items in Module 2. So I'll use a condensed set of slides. So I'll have a go at bringing them up on screen now. Okay, so in Learning Outcome 1, we're going to look at the historical development of the financial reporting environment. And when we ask what financial reporting is, we can say it's a process involving the collection and processing of financial information to assist decisions being made by parties external or outside of the organisation. Now, we don't know who these people are. We don't know exactly what they're going to use the accounting information for, so we have to make assumptions. We make assumptions about the basic knowledge of the people who use information and the kinds of decisions that they're going to use. We call these external financial reports general purpose financial reports, or as an acronym, GPFRs. But if we take a trip back through time, it's useful to know where financial reporting came from. Now, accounting has been around ever since people have lived in societies and needed to account for their wealth. But financial reporting, as we know it now, really had its origins in Renaissance Europe, in the Mediterranean around the 13th and 14th century, when a lot of Western traders, principally from what we now know as Italy, interacted with the Arab traders. And the Arabs brought us the numeral system that we still use today. And with that came a much more advanced set of mathematics. So the traders grabbed hold of this and they pretty quickly dumped the old Roman numbering system and used the new Arabic system and used it to better record their trades, their transactions and their wealth. And pretty soon things such as double entry systems began to be invented. The person we best know here is Luca Pacioli. He's often been called the father of the double entry system, but his genius was to actually codify it and record one of the many systems that were being used by the Venetian merchants at that time. Fast forward from there, around the late 19th century, as a direct result of the Industrial Revolution in both Europe and North America, we have accounting societies starting to be formed, trying to professionalise the process and the practice of accounting for companies. So in 1854, we have the Society of Accountants in Scotland, followed by 1880 by the Institute of Chartered Accountants in England and Wales. And then in 1887, we have the Americans getting on board with the American Association of Public Accountants. Now, there's still no government regulation at this time concerning the production and presentation of publicly available financial reports, but you can see the practice of accounting itself starting to formalise. Early forms of regulation were in the early years of the 20th century and largely driven, of course, by the onset of the Great Depression. We find a lot of accounting principles and doctrines being codified, such as conservatism and materiality and the matching principle. And the Americans did a lot of work in this regard. So in the USA, the first formal regulation of accounting information came in 1934 with the US Securities Act, which required specific disclosures, minimum disclosures by companies seeking to trade securities in the United States. And in 1938, the SEC would only accept financial statements prepared in accordance with the generally accepted accounting principles, or GAAP, which is what the USA refers to as their accounting standards. Mandatory requirements to use accounting standards came about in 1970 in the UK and 1973 in the USA. And the expectations of accountants were wrapped up in these accounting standards. So accountants were and are still expected to be objective and free from bias, to generate financial information that faithfully represents the reality of the entity, and to exercise professional and ethical judgment in their decision making. So that's a quick tour of the development of financial accounting and the origins of regulation. Of course, there's a lot more to it than that. Your textbook gives you quite a short history, and it's useful to do your own research in this area because it's very interesting. And there's been quite a lot written on the histories of financial reporting. So that's all for Learning Outcome 1, and stay with me and I'll give you the following 2 learning outcomes. Bye.